Good morning, good afternoon, good evening, everybody who's joining us for the webinar. We'll get started in just a minute. We're just going to wait for people to connect. All right. Hello, everybody. As people are continuing to connect and log in over the next minute or so, we can get started. Welcome. Thank you for joining us for this joint webinar with KPMG and Navisto on the external assurance of ESG data, what it's all about. We're really happy and excited to be with you here today to talk about this. We believe it's a very important topic. It's an important trend in corporate sustainability reporting. I am MJ Privik. I'm Chief ESG Innovation Officer at Navisto. I am joined by Marie David, who is Audit Partner, and Edith Saint-Mars, who is a Senior Manager for the Audit Practice for KPMG Canada. The first part of our presentation, I will be giving you a little bit of an overview, very briefly, of why ESG external assurance is coming. And then I'm going to turn it over to the folks at KPMG to talk to you all about what it is, what companies need to do, and what auditors are actually doing in conducting an external assurance practice. Without further ado, I will, everybody can see my slides. I'm just going to look for Edith and Marie, you can nod that you're seeing my slides. All right. Corporate ESG disclosures are becoming a must. There are market drivers, significant market drivers that are pushing companies to report on their sustainability practices. The three major ones. One is that most large companies in most countries around the world are today producing a sustainability report in one form or another. The second is that investors, most investors today are by and large integrating ESG considerations into their investment decision-making processes and their capital allocation decisions. And we're also seeing a number of jurisdictions issue either hard regulations or soft laws being guidance and frameworks on promoting or mandating the disclosure of information from companies. Importantly, also as a result of all of that, stakeholders care. Stakeholders want to know what companies are doing, how they are integrating environmental, social, and governance issues and embracing sustainable business practices. Who are stakeholders? What stakeholders are we talking about when we say that? There are many. One of the most important historically until now has been investors, obviously, because capital is such an important consideration for companies. Investors, as we mentioned, integrating ESG into their investment decisions, either to optimize returns, but also increasingly to address system-level risks, think climate change, biodiversity loss, income inequality. Another very important stakeholder, increasingly and very much so for the smaller, medium-sized companies, private companies are large customers that are managing their ESG issues throughout their supply chain. So a lot of companies aren't public, don't have to disclose, may not have investors, although some private companies do, but many of them, most of them, happen to be part of a supply chain and so have large customers. Consumers, so any B2C companies, consumers increasingly wanting to buy products and services that are produced responsibly and that respect the environment and people. Regulators issuing policies and regulations, as we saw, for companies to both do different things and disclose. And then employees increasingly choosing to work for companies that are behaving responsibly, and in a tight labor market, that is particularly the case. When employees have a choice of where to work, they will be looking to work for companies that they have an affinity with and that they believe are behaving responsibly. What we're seeing in the market is a change in corporate sustainability reporting. increasingly to being regulated. More importantly, regulations which are going to make disclosures widely available. So filling that availability gap. Regulations are also stipulating that those disclosures be standardized, so follow a specific standard, which will make them comparable, that those disclosures be externally assured in order to make them reliable, and that they be digitized and XBRL tagged in order to make them shareable and also discoverable. So not only readable by humans, but readable by machines. The reporting ecosystem is effervescent, but the fog is lifting. I will not go into the details of all of this information. Feel free to circle back to them when you get a copy of the slides, but it's basically to illustrate the fact that there are many things happening in this space along these four pillars, if you will, or four major trends of regulation, standards, audit, and digitization. And today we're going to talk about the main ones. They're going to come back over and over again. A good way to summarize the evolution of sustainability reporting is from an exercise that until recently has been largely voluntary, informal, unchecked, and unstructured. Largely done, it could be done by a number of different people within the company, but very often either standalone ESG sustainability or communications, public affairs, sometimes compliance, sometimes investor relations. That's evolving towards an exercise that is mandatory, standardized, audited, and digitized, largely evolving towards the finance and accounting department. Why? Because the finance and accounting department, at least for publicly listed companies, are very, very familiar with mandatory, standardized, audited, and digital disclosures. We're also seeing an evolution towards this concept of the two pillars of reporting, So corporate reporting isn't just financial reporting anymore. It's financial reporting and sustainability reporting. And within that pillar, there's then a further subdivision, if you will, of impact on the company. So financial materiality, impact of issues on the company's operations, and then impact on the environment and society. So we're talking about impact materiality. So how the business how the company through the conduct of its business is impacting the environment and society. Again, I won't go through the details of this slide, which basically gives you a very high-level summary of three of the most significant trends to follow in the space: the IFRS Sustainability Disclosure Standards, the Corporate Sustainability Reporting Directive, and the European Sustainability Reporting Standards in Europe, and the SEC Climate-Related Disclosures. You have a good overview here of regulations, standards, and then a combination of regulations and standards. And we're going to, have an opportunity to circle back to some of these items throughout the presentation today. So without further ado, I'm now going to turn it over to our colleagues here at KPMG for the rest of the presentation.
Thank you very much, Marie-Josée. Let me share my screen here and let me know if you see it.
Yes.
Yes. So as introduced by Marie-Josée, it's a pleasure to be here to talk to you about more deeply about assurance, ESG assurance. We will discuss in our portion of the presentation a bit more about why, she already introduced it, but why ESG assurance is so important, and then what it is. We don't intend to make you expert, but to let you have the feel of what it looks like, what are the standards in place, the level of assurance, an example of audit approach, and then how you can get ready for that, for ESG assurance. So I am Mary David. I'm an audit partner in KPMG Canada, working from the Montreal office in Quebec. I'm also the ESG assurance leader in Quebec, and I am with Edith Cinq-Mars, working with me also as a leader for the assurance practice. She is a senior manager. And so let's start with why ESG assurance, just to continue and build on what Marie-Josée was saying. So yes, we as auditors and accounting firms, we see an important increase in demand for ESG assurance on sustainability, on ESG reporting and sustainability reporting in general. And the markets could be the investors, external stakeholders, as Marie-Josée was saying, internal stakeholders like employees, everybody is looking to have information that is reliable and also comparable. And so we will explain a little bit more after on what are the standards available or coming. Some are in proposition phase for now, but in order to assure on something, we need to be able, if you make a comparison to financial information audit, financial statement audit, and I will explain more later, but when we want to assure on something, we need to be able to mention in our auditor's report or assurance report that it is in compliance with something. So we need guidance, we need a framework, we need standards so that we can see, because we cannot just say that a metric is good, is accurate. We need to say that the information is in compliance with something. So we will let you know what are those, we will tell you more about those frameworks and how we include them and work with them in our assurance practice in order to meet the demand, to respond to the demand from all the stakeholders on the reliability, on getting available and comparable, reliable information. A bit an overview, and as Marie-Josée was saying, like there's a lot of detail, so we don't want to go into too much detail here, but you will have access to those slides after if you want to have a better reading and take your time to read and digest all of it. But there are already a lot of framework and some organization developing standards and frameworks that companies can use to, on a voluntary basis for now, and it's coming mandatory in the different jurisdiction, but to report and to be able to report in compliance with a framework. So here are the ones that are the most commonly used by our clients. What we can see also on the slide is that the SASB standards, the TCFD, and the standards developed like the International Integrated Reporting Council, and what they suggest will be eventually the ISSB, which is the International Sustainability Standard Board, is looking to regroup, like amalgamate the propositions from the SASB, the TCFD, and the information that is required from all those frameworks to be included in one set of standards. So the IFRS S1, IFRS S for sustainable standards. So standards that would cover, and Edith will tell you more about ISSB, but standard that would kind of regroup information that is presently required by if you want to be in accordance with SASB, TCFD. And so GRI, for the folks here today that are coming from, that are in Europe, maybe you know a lot about GRI, because in Europe, this was the most commonly used gold standard of sustainability reporting due to how broad it was in terms of its coverage of ESG themes. It is an inside-out reporting approach that allowed organizations to communicate externally on various topics and initiatives that the organization is undertaking related to ESG. Its audience, for GRI, the audience is broader than for SASB, TCFD, which are more focused on capital providers, shareholders, so more from an investor perspective, while GRI is broader. TCFD and SASB have similar audience, as I just said, so being more focused on investors. And this is also why the ISSB, which is kind of a subgroup of the IFRS group, is also aligned more, like the objective of the ISSB is really to get the investors. So there is a focus on investors, the more reliable information. So I'll let Edith continue on a comparison of those reporting proposals.
Before maybe Edith, you take over, just I forgot to mention at the beginning of the webinar, if you have any questions, please share them in the Q&A. We will be taking a look. We're going to try to go through the bulk of the content because a lot of questions typically get answered as we go through the presentation, but we'll definitely be looking through those questions and have some time for Q&A afterwards. So please don't be shy and put your questions in the Q&A.
Thanks, Marie-Josée. So what do these proposed regulations and standards have in common? So the TCFD acted as a main key input for each of these proposals. So I know Marie just showed you a lot of different frameworks. So the TCFD was the main driver for all of these proposals on the screen. Just as a quick reminder, the TCFD has 11 recommendations that are centered around 4 pillars. That is governance, strategy, risk management, metrics, and targets. Just so you know, most companies that were reporting to date on a voluntary basis under this framework, the TCFD, were not fully compliant with all 11 recommended disclosures. So the ISSB operates under the International Financial Reporting Standard, the IFRS Foundation, with the aim of establishing sustainability reporting in mainstream reports on the same footing as financial reporting. It followed the same 4 pillars as the TCFD structure. The proposed S1, which is called General Requirement for Disclosure of Sustainability-Related Financial Information, and the proposed S2, which is called Climate-Related Disclosures, are still expected to be finalized in June of this year. Some individual jurisdictions will have to decide how to adopt the ISSB standards, for example, in its entirety or as a baseline. The Canadian Sustainability Standard Board, the CSSB, was announced in June 2022. The CSSB has the mandate to streamline the adoption of sustainability standards in Canada. So moving on to the CSRD or EFRAG. So the European Corporate Sustainability Reporting Directive, so the CSRD, released their first set of draft European Sustainability Reporting Standards called the ESRS. The ESRS are much more rigorous in scope and depth disclosure requirements. There's over 100 of metrics and targets within 10 specific topics, such as biodiversity, resource use, treatment of your own and supplier workforce, business conduct, etc. The EFRAGs are mandatory under the CSRD, with different mandatory adoption dates depending on size of company. Also, a Canadian company will fall under the scope of EFRAG if one of the below applies. So it has either a European subsidiary for which 2 of the following apply. So 40 million and more of revenue, more than 250 employees, more than 20 million of assets. The consolidated group earns more than 150 million in revenue in the European territory annually, with at least one of its subsidiaries in the European territory, with revenue of more than 40 million. Or it is a listed or large insurance company or a credit institution. So Canadian companies should begin to assess the European requirements to determine if they're within the scope, because this is going to be a challenge and a future burden for compliance that is coming quickly. Finally, moving on to SEC. So in addition to the ISSB standards that will eventually come into play for SEC registrants, the SEC issued its proposed rule called the Enhancement and Standardization of Climate-Related Disclosures for Investors, which is basically how climate-related matters impact a company's business and financial results over time. Scope 1 and Scope 2 GHG emission disclosure by accelerated filers and large accelerated filers would be subject to assurance requirements in fiscal year 24 and 25 respectively, which will start with a limited assurance and moving toward reasonable assurance in future years. I will discuss this more on the next slide right now. So just as I spoke about, so regulators are pushing for ESG assurance. To this day, the proposal for ISSB would first apply for years beginning on or after January 1st, 2024. That would be for the IFRS S2 rule, and the following year for IFRS S1. For SEC, as I just mentioned in the previous slide, the only effective date so far relate to Scope 1 and Scope 2 GHG emission disclosure. And the other dates shown here are in the table for SEC are based on an illustrative example included in the proposal, which will remain open until final adoption of the rule. For EFRAG, the proposal would first apply to companies with year-end beginning on or after January 1st, 2024. So the calendar here depends on the size of the company. The table here are not showing specific dates, as most of the dates are in the proposal stage. But the key takeaway here is that you can see that the estimated mandatory assurance requirements following official adoption of the rules is estimated to come either on the first year of reporting or within 1 or 2 years following the first reporting date. So this is coming quite quickly. Then moving on to the next slide. So as shown in the previous slide, the CSA, the SEC, the ISSB, and EFRAG proposals have various areas where they're not fully aligned. This will create some challenges for organizations trying to design a consistent reporting that meets the needs of both global investors and local jurisdiction requirements. This may bring companies into the scope of multiple frameworks if they're part of sub-consolidations or consolidation groups, for example. So under these frameworks, what greenhouse gas emission reporting would be required? When would they be effective? What assurance would be required? So here the table shows you the answers to these questions. You can see that most of them are aligned with Scope 1, 2, and 3 requirements and aligned with the GHG protocol, but they differ in they do differ in intensity metrics and disclosure targets, as well as assurance requirements as discussed in the previous slide.
So let's, thank you, Edith. Let's continue by explaining more what is ESG assurance. The first part was just meant to be kind of a reminder for some of you, and maybe a first ESG 101 for the others, but now the purpose of this training was really more to focus on ESG assurance. So let's have an overview of the different type of assurance engagements that we can have. And I'm really using the word assurance that is a bit different than audit. And I will explain you more after, but there are different types of ESG assurance engagements that we can offer, and it really depends on what is the information that the company wants to be assured on, and like, am I satisfied with the information that I am reporting publicly? And this information could be a full ESG or sustainability report, so we can assure on from a voluntary. For now, it's voluntary, but it could become mandatory. We can assure on quantitative KPIs, on qualitative KPIs, also on all E, S, and G. And that type of assurance would covers historical non-financial information. So that is different from financial statement audit. And that includes quantitative indicators contained in ESG reports or integrated annual reports. And it is made in accordance with international standard of assurance engagement 3000. I will tell you more about this assurance standard right after. We can also have provide assurance, ESG assurance on the GHG emission. So that is quantitative. That could be the scope 1, 2, and 3 that it was talking about. And that work, so those ESG assurance engagements, those GHG emission report and KPIs, if we want to assure on, we would need to follow the guidance of the assurance standard 3410. That is more specific. So the standard 3000 is kind of an umbrella for non-financial information, and then 3410 is more specific to what relates to greenhouse gas emission. And so we can also, so those are the two that we normally think about when we think about ESG assurance report. But we can also, and we do have a lot of clients that required our services for sustainability linked loans or sustainable bonds. So they are asking us to assure on the use of proceeds from green bonds or on their performance targets and measure for sustainability related loans. Some companies have access to lower interest rates because they agreed with their bankers to report and perform on some targets related to ESG. That those targets could be quantitative. It could be on environment, but it could also be like diversity and inclusion targets. And so they would report on it, and sometimes it's not a public report. That would most of the time be a private reporting to the bankers on their performance. So that, and obviously when such sustainability linked loan exists, the banks want to have an assurance opinion so that they can trust that the information reported by the entity is accurate. We can also offer service of like ESG assurance report for ranking submissions. So there are organizations that provide information on benchmarking, peer benchmarking, and how companies are performing in terms of assurance. And so we can also have specific assurance report on the ESG metrics, including GHG emission, for those organizations that are trying to rank companies. And also the last one here is to assure on progress towards carbon neutrality and zero emissions goal that more companies, jurisdiction like provinces have put like as goal. That there's more and more companies trying to be carbon neutral by X date. So this is most of the time a voluntary assurance, and that often increase the credibility of the achievements of the climate goals. So those are different type of ESG assurance that we can render. And so in terms of standards, the actual standards that we would follow, as I mentioned, there are the international standard on assurance engagements, so ISAE. In Canada, we have the equivalent, so the Canadian standard of assurance for assurance engagements. So the standard 3000, that is effective since 2015. So it's not new. It was not developed only for ESG engagements. It was developed for all it's for engagements other than audits or review of historical and financial information. So it covers almost everything that is not financial information. It was designed by the International Auditing and Assurance Standard Boards, and it covers, like I said before, it's kind of an umbrella. So it covers all this type of assurance engagements. And we have in the standard common language on how to guidance on the acceptance of the engagements, planning, risk assessment, documentation of your file, what is the type of procedures that you should perform, the format of the report, and all that. So all this information and guidance is in this standard. There is one that is more specific. So the standard 3410, that is kind of a substandard of the 30,001, and that is really more specific on greenhouse gas emissions. Here is a comparison of financial statement audits that you are probably more common and that you know probably more versus ESG assurance. So there are a lot of similarities. Like in both cases, the idea is to ensure the user of the report, and so the user of the sustainability report, that the information included and that the metrics are accurate and complete and well described. There are a level of assurance though. So we can have, same as for financial statement audit, we can provide a limited assurance or a reasonable assurance. That is a higher level. The reasonable assurance is a higher level of assurance. The long-term objective is to reach reasonable assurance for ESG disclosures in general, and that is what Edith was saying about the regulators asking for, you will have to start reporting on this date, and then maybe a year or two later you'll have to get an assurance on your sustainability information. It starts with limited assurance, and then 1 or 2 years later to have some reasonable assurance. So companies should really get ready for this. And so those are the similarities, but the differences are obviously the auditing standards are not exactly the same for a financial statement audit. It's as per the International Standard of Audit, or the Canadian one, or the US one, while the ESG assurance engagements are performed under the ISAE 3000 or 3410. But the main difference that you will feel, or as company reporting, but also as a customer and investor using the report and looking at the information from other companies, is that our assurance opinion will not cover the whole report and everything that is mentioned in a sustainability report. For financial statement audit, our opinion covers the whole set of financial statements. But for ESG assurance, we need to identify what is the subject matter information that we will specifically report on. So that is really different. We will not report on provide assurance on the whole report. And so the subject matter information needs to be agreed upon in the engagement letter and clearly stated in our auditor's opinion. And the criteria that we need to comply with, as I was saying in introduction, are different. In financial statement audit, companies comply with either IFRS for public companies, or US standards, Canadian standards, or private standards of reporting. So this is more really on the accounting side. But then for ESG assurance, there are a bunch of standards now that are developed or already available. And there are also framework more general, saying how you should report, on what you should report, like in general. And then there are some more specific standard developed as it was also mentioning, like IFRS S1, S2, the multiple standards included in the ESRS. So in either cases, what is important is that the company that reports on sustainable information and ESG information in general clearly mention what is the framework and that was using, and the standards that the information is in compliance with. And our assurance opinion will refer to this as the criteria that was used in the report, and as the subject matter of our assurance work. And we will also, you should know that in a sustainability report, there could be a bunch of metrics, and companies can decide to get assurance only on some of them for many reasons. and especially now, because it's still voluntary, they can choose on what metrics they want to get an assurance on. And so our report would clearly state which metrics we worked on, and on which metrics we want to report, and the level of assurance could be reasonable and limited. I already mentioned that. So here is the distinction between limited assurance and reasonable assurance. So let's start with the reasonable one that you know probably more. So like for financial statement audits, our assurance is what we call a positive assurance opinion. So we say in the report that in our opinion, the information is presented fairly in all material respects. And so in limited assurance, and I know that the distinction, that like the nuance is maybe not that big for the readers, but there is a big nuance in the level of assurance that is provided. But the limited assurance, what we provide is, what we mention in the report is that nothing has come to our attention that causes us to believe that the information is materially misstated. So I'm not saying that the information is right. I'm saying that I haven't seen nothing that let me think that it is misstated. So there is a big difference here. And so the type of procedures that would be performed in order to provide a limited assurance is more based on inquiries, observations. We can perform some analytical procedures. We are doing sample testing, but not on a statistical basis. So that leads to lower sample size. We also recalculate certain like numbers, reconciling numbers between the data sets and all that. But for reasonable assurance, we also do this, but we add on normally more testing on controls, so that the design and implementation of operating controls, and our sample testing will be statistical, so larger sample size, and we will have extensive recalculation and reconciliation. And some companies can use a combination of reasonable and limited assurance. So our report could be, we can state in our report that we are providing a limited assurance on this, and this KPIs, and a reasonable assurance on others. So it's really more flexible for ESG assurance. Over to you, Edith.
Thanks, Mary. So what does an audit look like? So it starts with phase one, which is usually called planning and risk assessment. So during the stage of our audit, we're trying to get a better understanding of the processes in place, the system collecting the data that will ultimately be under the audit, quantification methodologies, etc. We're also establishing a materiality based on stakeholder needs and focus. This materiality will serve as our benchmark for the audit. During this phase, auditors usually ask for internal documents which will be relevant for the understanding of the environment. Can be policies, reports, written communication, and procedures. Auditors also usually conduct interviews with different employees in the organization to better understand the processes and the general environment surrounding ESG reporting. And this will serve us to better align our audit procedure in accordance with the ESG environment in the organization. The phase two, which is the interim. So during this phase, we perform inquiries, walkthroughs over data collection and reporting processes. So we go a little deeper than in the previous phase. During this phase, we can also start testing some available data. And we do sometimes identify potential weaknesses. Marie will cover them later in the presentation. It could be weaknesses in data quality, but this allows us to adjust our audit procedures accordingly to address those specific risks. Finally, the phase three, which is the last phase before showing our opinion. So it's after having understood all of this environment, align our audit procedure according to the planning phase. We execute the year-end phase. This is really to gather all the sufficient assurance evidence that will support our assurance opinion. So on the next slide, what can you expect in terms of all of these phases? So these are different types of procedure we usually conduct in order to obtain those sufficient assurance evidence that will support our opinion. And you can see that for each of these procedures, we require certain information from our client. So I won't go into the details. You'll have the detail of the slides later on, but just for an example, for confirmation, this is a standard procedure. So we would request a listing of the data that we're trying to confirm. We would need the supplier contact information in order for us to contact the third parties directly to request confirmation on the data that we're trying to get comfort over with. So moving on to the next section, so how to be prepared for ESG assurance, which is an important part, really. So number one, establish. So management will need to identify which metrics are considered material for the stakeholders and for their business, and therefore which metric will merit assurance. For example, labor conditions in the supply chain could be a key area in which a retail organization customer may want assurance over it. Number two, assets. Management will have to assess the organization capacity and capabilities in meeting those reporting requirements that we discussed earlier. The data collection capacity, IT system functionalities. Is there enough employee to support the ESG function internally? So this is for the access phase. Number 3 and 4, so the design and implementation phase really takes time. After having assessed the capacities and the capabilities internally, the design and implementation phase can be laborious, may involve lots of trials and errors until proper processes and controls are in place to meet those requirements. Number 5, sustain. So an organization will have to sustain the processes and the controls that they have put in place. They will have to monitor the results and enhance those processes and controls on an ongoing basis. Finally, the last point, so assurance. Organization can start with readiness assessment. So this is an understanding of what are the preconditions for assurance, which I'll cover on the next slide. And those preconditions for assurance, readiness assessment can help organizations to reduce the risk of encountering issues in the future that may lead to scope limitations or modified assurance opinion, as Marie earlier discussed. So this is really essentially a preparation for the real assurance engagement. So those assurance engagements, on top of meeting standards requirements, it will provide the public information that is accurate, robust, and credible, will give organizations the opportunity to test any significant judgment they may make in measuring ESG metrics. Obviously, it will spur investor confidence, reduce the risk, exposure to risk, and like Mary mentioned earlier, it will support in securing access to better financing from credit institutions. So on this slide, like I mentioned, the precondition for assurance. So here the slide essentially shows you some elements that are considered to be preconditions. Without those elements present, assurance engagement will be challenging. So we're talking about roles and responsibility, consistency, suitability, availability of evidence to support our assurance opinion, written reports, and a rational purpose for the assurance engagement.
And if we don't have all that, here are examples of what can go wrong and some example of what we have seen as auditors. And so the more manual entry, the more manual data and manual data entry, the higher is the probability of a human mistake happening. So to implement an automated data collection systems reduces the associated risk. So really, and we need to I guess you already understand that ESG information is non-financial information. It's coming from a lot of your systems within the organizations. So there is, for what we see now, there is most of the time a lot of manual interventions. And so the data is not even accessible in sometimes in a format that you can calculate your metrics and your performance. So there are manual entries, which can lead to more errors. There could also be failing quality systems. So without a proper quality systems in place, the quality of the data entered by the companies can be very poor. And so there should be frequent controls and proper data management to mitigate the risk that the quality of the data is not good enough. There is also, where we can see also is a time lag. So for now, most of the ESG professionals and companies are used to report on deadlines that are not necessarily aligned with the financial statement and annual report date. But what we can see from the standards and what is asked by the regulators is that this information will eventually have to be reported at the same time. So companies need to put the processes in place to ensure that the information is available on time. Otherwise, if we lack access to documentation and information, that could lead to a qualified opinion. There is also often limited scope because some certain subsidiaries maybe are not ready, don't have access to the information on time, or don't have the good processes to provide the data to the corporate team, so that companies decide to limit the scope of their report, which is okay. But if the scope is too restrictive, then sometimes it's not sufficiently representative of the group. And so sometimes we have qualified opinion because of that. There's also use of multiple systems to collect data. So if the more integrated system you have, the better it is, because the information is collected into one, regrouped all together. There's less manual entries, again, to report and extract some data from one system and give it to the other one. And then there could be a lack of documentation, a lack of shared methodologies. So that's also a problem. Sometimes we see that there is no good process documentation or the traceability of the information, so that we can trace it and have kind of an audit trail. So in order, and that's the last part of the presentation, we will keep time to, and I know that Marie-Josée are trying to answer most of the questions that you have in the Q&A, but for some of them, we may decide also to respond directly. I think it will be easier for some of them, and we will try to keep some minutes for that. If we don't have enough time to answer all the questions, we can provide the written answers after on also. But let's just here, I'll try to make it quick, but when you want to get ready for ESG assurance, you need to ensure that your reporting will align with the standards. So you need to know which frameworks, which standards I want to report in accordance to, and because I'll have to refer to that in my reporting. And then sometimes you will have some gaps. Like there will be some information maybe not available on time or not available at all, and you'll have to estimate. So you can use historical data to develop estimations, but then you'll have in your report to fully, transparently explain what information you used, how you came to this metrics, and how you calculated your performance. So that's kind of a cool part with the ESG assurance when we compare it to financial statements, is that you can do, like, as long as you explain exactly how you calculated, where you took the information and how you dealt with it, then it's good. But you have to comply and to report in accordance with one of the standards. You also have to have consistency in your KPIs, consistencies in your boundaries and scope. You don't want to scope one division in 1 year and then scope it out the next year because something bad happened, and you don't want to. That would let's say have a bad impact on your performance for GHG mission, for example. And so you decide the second year to scope out something. You can't do that. You need to be consistent in what you're reporting, and you also have to clearly state the reporting period. And sometimes it's not only annual. You could have some trimestral, some quarterly reporting, and you have to very specify what is the period covered by your reporting. Then in terms of data integrity, governance, and archiving, you need to have to identify data owners and the accountability, responsibilities of people in the team. Same as for financial information, you have to get the same level of comfort, the same level of rigor in your processes than what you have for financial information. So in order to do that, you need to formalize and share policies, processes, and to also document all that and share it with your team, so that everybody, especially in big groups with some subs in other countries, so that everybody is using the same policies and methodologies when they calculate their performance. Data archiving, as for financial information, you need to define the delays, the process to ensure that everything is documented and that you have access to the information and keep access to this information later on. And then there's also some IT controls that you need to consider: user access, the traceability and documentation of the information. You need to get an audit trail so that we are able to perform our work. And the information needs to be accessible. So we see some companies that are providing us access, like a direct access to download and view the source data. Obviously, we can't modify, so it's a reader access only, but that makes our job a lot easier, and that also can fasten the process. And you need to have in place some data validation, sign-offs, data quality to ensure that you have the processes, and you should implement some internal controls to look at the information. You can yourself have some trends analysis, have some approval controls, so that you can ensure internally that the information is accurate before it is assured, before it is looked at by an independent auditors, or because in some cases you will report on information that maybe we won't have an assurance report on. So even if you don't have an assurance report, you as companies want to provide the market reliable information. Everybody wants to avoid greenwashing, so you need to pay attention to the information and the processes, and again, ensure that the controls and all the processes in place are as rigorous as they are for financial information. So in the presentation, we have appendices that I won't share right now, but you will see in when we will send you the written presentation if you want to read more about the evolution of assurance and all that. So I'll stop sharing.
Thank you so much, Marie. And we're almost at the top of the hour. So we did answer a lot of the questions as we were going along. Hopefully that was helpful for everybody. As Marie mentioned, if there's any questions we didn't answer, if you want to circle back to any one of us afterwards, we'll be happy to respond. If there's a way for us to submit those answers in writing, we'll find a way as well, but sometimes that's not so easy. And I know there's a couple of questions still pending in the Q&A, Marie, but I'm going to use the privilege of being here because I would have wanted to write them out, but I can't. So maybe asking you very quickly a couple of things. Can you just specify when you say we need the different frameworks in order to have something to assure against? Love that. Can you specify that? Is that only standards, or do you also assure against a framework which is less rigorous and less specific, such as a TCFD?
Well, I think that for reasonable assurance, it will have to be as rigorous as really standards. Like, it's really difficult to have a reasonable assurance level, that level of assurance for something that is as general as the DCFD framework. It's too judgmental, and we can't report on something that is as judgmental. But we do include in our reporting that the report was prepared, like we was meant to report in accordance with the most popular one would be the GHG protocol. So, and when they say that, we do look at the GHG protocol and ensure that the scoping is like what it should be, so if we have obvious information that the report is misleading, we won't be able, we would have a qualified opinion on this. But to have reasonable assurance, it will need to be on specific set of standards.
Yeah, so I think that's really important for companies when they're figuring out and involving their corporate practices. Today, standards are voluntary, but they are increasingly expected to become mandatory in Europe. The path is clear with the IFRS standards. The path is also clear, but maybe a bit less so, because the regulation for the IFRS standards is going to come with the securities regulators. But I think that's an important dimension of, for you to have externally assured, reasonable level of assurance, externally assured sustainability reporting, you have to be applying a standard. So maybe not just a single standard, you can choose maybe from one or two, but a standard. So I'll just pop two questions real fast at you. One very quick, and one I think would be the closing item. Quick question on a quick word on the IAASB sustainability audit standards that are in development. I understand the first draft is supposed to be coming out before the end of this year. And then the closing comment would be, what concrete recommendations do you have for companies today that are either they've started, they have a few data points that are assured, or they're thinking about having this externally assured, or thinking, should I be thinking about having my data externally assured? What are the concrete recommendations you make to companies today?
It's a big ask.
I know.
I would say you need to have someone responsible in your organization, someone that will follow everything that's going on, that will understand what are the propositions, the recommendations, and the standards. And as soon as they are coming, and you can get prepared and you should get ready for it, even if it's not final. You should look at all the propositions that are there in the market. It's not, yes, they are different depending on jurisdictions and depending on which regulators but at the end of the day, they are really similar. At the end of the day, companies will have to report on their governance structure about ESG. Will have to report on their strategy, the risk and opportunities, and then on some specific metrics. It's broader. Companies you need to understand that it's broader than just saying into the market, those are my greenhouse gas emissions. It's not only metrics with numbers. It's really your strategy, your governance, how you're dealing with the ESG. And in terms of audit, just to go back to audit, that will become mandatory. And it will be as rigorous, and it will feel the same for you eventually as a financial statement audit. The procedures that we are doing, the level of assurance that we want to get is as rigorous as financial statement audit. So you really need to get ready for it in advance to look at what is important for you and in your business, and then what is material. We did not have time to really go into the materiality concept, but you will need to assess what is material for you, and then to start looking at your strategies, the KPIs that are important for you, and to start looking at what kind of data do I have? Do I have access to the data? Do I have the processes to regroup that data, and then to be able to get it audited so that the processes are good enough, and the traceability and the evidence that I can provide to the auditors are as good as they are for financial information. So you really need to have a team for this, and this person that is responsible needs to have a visibility of the entire business. It's not a financial thing. It will impact the entire business.
Thank you for that. I know it's a big question to add, difficult to answer in a short time. I would, one, I guess the key takeaway, start now. And two, on the whole governance strategy, management specific metrics, that's entirely TCFD. If you're not looking at TCFD, take a look, because it's very commonsensical and it is going to be reflected in the standards and the regulations. So I think that's really good advice for companies. So we're up on time. Thank you so much, Marie and Edith. Thank you everybody for joining us. Hopefully this was insightful, useful. We'll have a recording and the slides available for you in a little while. Give us a little bit of time, and feel free to reach out to us separately if you have follow-on questions. And hopefully we do this again as a follow-up a little bit down the road, see how things are going.
Thanks, everybody.
Thank you.
Bye.
Bye-bye.